on Tata Power. I spoke with S. Naren, a CIO at ICICI Prudential AMC. Naren, of course, is a hardcore value investor. But where is the value? That essentially was the focus of our conversation. Listening to some key excerpts of that conversation.
Many of the sectors which we actually were positive on 3 years back, which were non-consensus, they all have played out. So we were positive on telecom, we were positive on power, we were positive on metals at that point of time. Metals, of course, played out very quickly. And those sectors have played out. So now we are actually struggling, which is the next set of sectors to play out at this point of time. Auto, for example.
Auto has played out.
Played out. All those have played out. So now we are struggling actually, which is the next set of sectors which actually will play out. That is why when we did whatever work we could do, what we realized was it is on capitalizations that it was clearer. So if you look at any sector, you take even a sector like banking and financial services, the top banks haven't done well. Whereas the bottom small banks, many of them small financial services companies, they've done extremely well. And if you take IT, the top IT companies have done badly. The small IT companies have done extremely well. So what we realized over a period of time at this point of time is that it is the mega caps in each sector which has done extremely badly compared to the smaller companies in the same sector.
Which have done well.
So this is what we realized. If you look sectorally, there were sectors which we used to be very negative on, like FMCG, for example. Those sectors have done extremely badly at this point of time. That no longer it makes sense for us to be so negative on these sectors. But the irony in these sectors is these valuations have not corrected. It is only that the other sector valuations have gone up substantially. So maybe on a relative basis, this sector has become cheaper, but not on an absolute basis.
Absolutely.
See, what we find is some of the conglomerate mega caps, they've all become much cheaper because they've underperformed significantly in the last 3 years. So it has become much more of a relative game to say this is better than an absolute game, because when you have had such a whipsaw big move in the last 3 years, and this is what we used to tell 3 years back, that there were so many cheap sectors at that point of time, and with lot of potential to put money. But those sectors, everything has played out. And that's why when I tell people that in the last 6 months we have told, even before this big move, that today the long-term return story is more moderate. People say, no, it can't be moderate. After all, we have seen very big returns. But we tell them 10 years, you've had more than 20% return in small and mid-cap index. And you know what we've seen from the real estate story of 2002 to 2013, when you have this more than 20% return in more than a decade CAGR, actually people tend to think that it will go on forever. But it never goes on forever, and you have to prepare yourself for a more moderate return period. But it's so tough to convince people that you're in for a more moderate return period, and that is very tough, because every PE which I had seen in 2003 to 13, in 13 what the price to earnings was in ICICI we used to discuss, and today what we discuss, we give valuations which are much higher than what we used to give in 2013 in our company.
Well, there are no cheap sectors anymore, but it's all about relative valuation.